Over the last few days, as recession risks have been mounting and investors have been seriously considering what might be next for our economies, we've been getting a steady stream of news regarding hedge funds, venture capital firms, basically institutional investors who are supposed to be the smart money in the market, but they've been losing money hand over fist during the first 3 months of 2022 as they've been roiled in absolute turmoil. Today, we're going to talk about two firms, SoftBank and Tiger Global, who have been getting absolutely ravished as the bull market conditions under which they made their billions have changed, and these investors have been incapable of changing and adapting to that new environment. So what exactly has been going on? Well, firstly, we have SoftBank, who are a pretty huge name in the investor space. It's a Japanese fund that is famous for its $100 billion vision fund, which is supposed to identify and invest in the next biggest companies in the world. It has had some huge successes in the past, being an early investor in Uber, DoorDash and OpenDoor, some pretty huge and well-run companies, but the biggest win for SoftBank was a $20 million early investment in Alibaba, now worth somewhere in the region of $60 billion. But as is so often the case with venture capital firms like this, their success goes to their head and they lose track of what they should actually be invested in as the venture capital scene got incredibly competitive and firms started competing against each other to invest in startups as opposed to startups competing to get investment. Now really, this is a problem with venture capital and Silicon Valley itself, and it's really coming to a head these days. Just last week, it emerged that a startup in the US called Fast, a payments processor worth almost $1 billion, has over 500 employees and yet only $600,000 of revenue. To be perfectly frank, that is absolutely pathetic, and the fact that the company continued to receive investment from venture firms based on nothing but hype is a serious indictment of the state of venture capital right now at the height of a QE-fueled bull run. So what was SoftBank's biggest loss? Well, I don't think I'll receive much flack when I say that WeWork was probably the one that fits that bill. The company was quite literally a fraud, almost on par with Theranos, run by a deranged hippie who somehow managed to convince the CEO of SoftBank that he was practically the second coming of Christ. In the end, the company slowly fell apart, which resulted in SoftBank losing $8 billion on this single deal. But I digress, because today we're talking about SoftBank because their Nasdaq whale portfolio has been liquidated after losing another $7 billion. Now this little fund runs under the SoftBank brand, under the name of North Star, and it made a name for itself buying up the kind of stocks that Cathie Wood likes. Nasdaq listed tech companies that talk a lot about innovation and creative destruction, but in reality they mostly just create software that they charge by the month for, have huge amounts of competition but throw such ridiculous amounts of money into advertising that they grow at a pretty huge rate. The reality is the software as a service model is not sustainable in its current form, and over the long term the huge margins that these companies have will be eroded away because the competitors are usually basically the same. The best example of this is, in my opinion, DocuSign, who basically just allow contracts to be exchanged online. They're a fine company, their software is good. The problem is there are over 100 competitors who provide a near identical product, and in the long run, margins will be driven down by this reality. The only reason they aren't being driven down yet is because they are able to grow at ridiculous rates by, again, just throwing money at that growth. Now back in 2021, North Star held $17 billion of Nasdaq companies. It lost $7 billion outright as the index as a whole, but in particular, the smaller companies on the Nasdaq crashed across the board by 40%, or actually far more than that in some cases. As for right now, what used to be known as the Nasdaq whale now holds only $1 billion of stock from that index. Really, what we're seeing here is the fund die. It lost huge amounts of money buying into hype and has basically had its assets stripped, as Sun, the CEO of SoftBank, has now fired the man who ran that fund for his failings. Next then, we have Tiger Global, another hedge fund that concentrated on high-growth tech companies. This one, though, is run by Chase Coleman, and he basically became a star hedge fund investor almost overnight as he made billions from the right bets. But just as we saw with SoftBank, Chase has been completely incapable of recalibrating his fund and changing along with the times. What was once a $100 billion behemoth is faltering. At the end of March, of course, that's the first quarter of the year, we see that Tiger Global lost a massive 34% over just 3 months. That is following the entirety of 2021, where the fund lost 7%. And then on top of that as well, this is looking at the fund after the 2-week-long rally that we just saw. So Chase is actually quite lucky to only be looking at losses of $34 billion. Now, he has come out with a statement to his investors saying, "In this moment, we are humbled but steady in our conviction and confident about the go-forward opportunity. We are reassessing and refining our models using all the inputs available to us." Ironically enough, back in the late noughties, Chase saw a very poor year as well, as the global financial crisis hit and his fund saw losses of 26%. That time he came out and said that he was going to regroup and refocus on his tech roots, where the companies he invested in couldn't be interfered with by politics or macro events. To be perfectly honest, that is a ridiculously stupid thing to say, considering how the tech boom over the last decade has been fueled by quantitative easing and loose monetary policy, and at some point that was always going to end and the bull run with it. He also seemed to think that tech stocks are somehow immune to macro events, which has been thoroughly disproven over the last couple of months as tech fell the hardest on the war in Ukraine. It doesn't help that Tiger Global is a huge investor in China as well, with its stake in JD.com being the biggest in its entire fund. Apparently, he thought that Chinese tech companies were immune to the moves by the CCP as well, something which is obviously just not true. To make matters even worse, the tech crackdown in China has not stopped, it's just not being reported on. Right now, as we speak, the CCP is targeting live streaming as its next victim, something that I will be explaining to you all in absolute full at some point in the future. Now, this all sounds a little bit familiar, no doubt, to someone we've spoken about a lot in the past, Cathie Wood, of course, and her flagship fund ARK, which has come to encapsulate the tech hype investor, with it literally being used almost as an index fund for the Nasdaq companies that have been falling the most. Now, Cathie, like Tiger Global and SoftBank, were revered and celebrated for their successes a mere 2 years ago, only to be utterly mocked today. I even happened to come across this little article while writing this video, literally comparing Tiger Global to SoftBank and considering why they're seeing so much success and how they turn Silicon Valley on its head. Now, despite not even being a year old, that article is already hopelessly outdated and will serve to me at least as an example of how media can help propagate this kind of bull run too. The reality is, nothing is immune to our governments, not least investments. No matter how great you think the underlying business is, its valuation will always be dependent on what is going on in the world, who is in government, and what those governments are doing. And if there's a recession, well, tech is going to perform worse, not better, because as liquidity and capital dries up, those 50% revenue growths year over year are simply going to dry up as well. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Thank you all for watching. Stay stoic. Until next time.